Hello and good afternoon, friends. Hope everyone's doing well. Thank you for joining me and somebody very important to me in this conversation today about valuations. We're excited to bring you this information, and I'm a little bit biased, but I really feel like as it pertains to understanding and strategizing the value of your business and real estate in the early education space, no one has more experience and knowledge than the HINGE team in understanding what buyers and investors are looking for and what values that actually translates into. So we're excited to talk about that. It's one of my favorite subjects. So I am so thrilled to bring on one of the most talented people that I know in our industry, and more importantly, one of the best human beings that I know, and that's Rusty Bailey. Rusty, thank you for joining me today. I know you have a lot of valuations to run, so you're super busy, but thank you for being here.
Thank you for having me, Kathy.
Yeah, I am going to, so I do want to tell you guys that Rusty will be less complimentary than I will be. Rusty, in my opinion, with his background, which he'll share a little bit of because I asked him to, is the most experienced and talented person in creating financial models for exits. And it's much more complicated, which you guys will see, much more nuanced and much more strategic than just taking your financial statements and saying, here you go, here's the opportunity, what do you want to give us for this business? So that's not how we roll. We work with you guys to present information in a way that highlights your company and also positions you in the same way that we know buyers and investors want to look at it. So I am going to turn this presentation over to the expert himself. I will be moderating Q&A and chat. So you guys, again, feel free to communicate with us there, and then I will hop on again at the end for a couple of minutes, and Rusty and I will take questions. So thank you, Rusty, and I will see you guys shortly.
Hello, everyone, and good afternoon, and some people, I guess, good morning. As Kathy said, I've been around the block a little bit. For my early education experience was started at childcare almost 39 years ago. That's hard to believe. I was there in 10 years when it was still located in Montgomery, Alabama. Of course, it's been in Portland since '97. So I think it's been in Portland now more than it was in Montgomery, but I'm proud that it was founded in Montgomery. So that's my little plug for little old Montgomery, Alabama. Next, I was at Nobel Learning Education, which was located in Westchester, Pennsylvania, from '98 to 2020 in various and sundry roles. I guess the last 7 or 8 years was on helping them grow by looking at acquisitions and being on the buy side, if you will. And then the last couple of years since 2020, HINGE. And I'm proud to be here. I'm proud to cap off a career here at HINGE. And so that's kind of my background. And as my bad accounting joke is, I always say I'm a fully depreciated asset still in service. So that's my bad joke for today. So what I like to do is start, before we get into the meat of the presentation, just a quick word about financial statements, mainly our client financial statements. Whenever we're doing evaluation, a lot of people are hesitant because they don't think their financial statements are any good. And I always say that if they work for you, that's all that really matters. I mean, we've dealt from shoebox of receipts to credit card statements. They're all set up differently. that it works for you is what matters. When we review the statements, we're not judging. We're not looking for anything. We're not the tax. We don't care about taxes. We're not the tax man. What we want to try to do is put together your financial statements that fairly presents the value of your business. And so if you ever contemplate doing a valuation, or you probably already have one, you'll know that we take a lot of time with trying to understand your business and figure that out with you. So we'll get started. EBITDA, earnings before interest, taxes, depreciation, and amortization. For many people, this is kind of a foreign concept. Some of the background for EBITDA. Next slide. There we go. Why EBITDA? So it became popular in the 1980s during the heyday of leveraged buyouts. I'm sure you all remember, well, maybe some of you do, the Michael Milken days and the buying and selling of companies. Why it's important is it kind of focuses on operational profitability. It's looking for the revenues and expenses that drive the business, or from core activities. And it also is a way to give apples and apples comparison to other preschools or your preschool by removing tax and debt choices and accounting elections, such as accelerated or straight line depreciation. So what that means is you take, taxes can be different by, everybody have a different tax structure. Everybody could have a different debt structure. So we take away all those elements and get down to really what the operating cash flow of the business is. And then, of course, being as a former CPA, most CPAs hate it because it's not generally accepted accounting principles, but it's used profusely in the industry. So that's a little word about EBITDA. So at a high level, how do we do this? How do we go about calculating EBITDA? So our business valuation methodology is we're looking at a go forward EBITDA. As I said, earnings before interest, that's income and expense. Taxes, which is income taxes, state and federal. It doesn't include property taxes or anything that's based on a percentage of revenue tax, and depreciation and amortization. So we'll start with your most recent 12-month financial statements. We'll look at your revenues and determine if there's any non-reoccurring revenues or income adjustments that would have to be made to properly reflect the 12-month earnings or the revenues received from your business. Make some other expense adjustments as the nomenclature is normalize the expenses to make sure that we've got a fairly presented expense structure for your school. And then, of course, we remove any personal expenses that wouldn't be a part of the business on a going forward basis if another operator had it, and they're not essential to the day-to-day operations of the school. So that gives us a go forward adjusted EBITDA, if you will. And then to get your value, we apply a multiple, anywhere from 3, 4 up to 7, 8, depending on a lot of different variables. And we'll kind of get into that a little bit later in the presentation. So we're going to do a sample case. It's a simple one. It can get very complicated the more schools you have, the type of overhead structure you have. And that could probably be a whole separate presentation in itself. So we'll stick with just a simple single school presentation. And what we see mostly is the owner or the seller, if you will, is also the director. So they own the real estate and they manage the school full time. And the real estate is typically held in a separate company or separate LLC. And then things like property taxes and sometimes insurance is paid out of the real estate LLC. And why that's important, we'll go over in just a minute. So first step is just to do the by definition EBITDA. So we'll take the net income, add subtract out any interest income, add back interest expense, add back taxes, and add back depreciation, which gives us what people call, by definition, EBITDA of $559,000. Then the next, you've got, like we said earlier, there's three types of adjustments: the revenue adjustments, expense normalization, and seller expenses. And all of these are art and science. Believe me, it can be quite the puzzle. So we'll start with revenue. Of course, anything like one-time grant income that's not reoccurring year after year has to be subtracted from your revenues. It's not as frequent post-COVID when companies and schools were getting lots of COVID grants. One example that we see sometimes, if there's a loss and there's some insurance proceeds for received, and it's not separate and put into other income category and is recorded in revenue, we have to go through and make sure that that is added back or subtracted out of revenue as well, for the same reason. It's a one-time revenue item that is not ongoing and can't be counted on by a new provider. And then we put this cash in here. I put the cash in here is because this happens less frequently now, but it still occurs. And we've got a number of people on our webinar today, and maybe some of you do collect cash, and don't put it in your account or your QuickBooks or your P&L because, hey, I want to save some taxes on it, and that's completely understandable. But when you get to a selling process, or you want to try and figure out the full value of your business, you want to have that cash incorporated as part of your earnings. But that can be hard to prove sometimes. Do you have receipts? Do you keep it separate in ProCare? Do you, or any of your other operating systems? Do you keep a record of it separately that can be proved and taken into consideration without almost without a doubt? And if you are, and if you're thinking about moving forward at some point in the future, you want to maybe start taking the cash and putting it in your P&L and putting it into your bank and reporting it, along with any expenses that you may incur when you use the cash. That's the other important thing when people say, well, I didn't report my cash, but you may have used some of that cash for expenses, and that's a lot of times hard to determine as well. So it's just best to kind of put it in your P&L and record your income and your expenses on a going forward basis. So for instance, you may save some taxes, but assuming a 5-time multiple and you receive $10,000 in cash, you could lose $50,000 in value. So that's just my plug for consider how you treat cash. I know many people have stopped taking cash, which is probably the best of all things. So in our example, sorry, Kathy. Yeah, so here's the one-time grants, $100,000. Insurance proceeds, we're going to assume, is $25,000. And then they collected cash, and we can prove it, so we'll add $10,000 back into the revenue. So there's a net adjustment of $115,000. Then we get into expense normalization. So there's a number of different items here. In this case, the owner or the seller is a full-time director. So, people want to exit. They don't want to run the business anymore, and they want to do something different going forward. So the thing is, we have to make sure that there's a director expense built into the financial P&L. So in this case, we're assuming that with wages and taxes is about $75,000. Then, as we mentioned earlier, this is a sample company that has a real estate LLC where they have the property tax expensed at the real estate company and not in the operating company. We want to make sure that the property taxes is in the operating company P&L, just to fairly reflect the operating expenses of the company. Rent, we're making an assumption here that there was a market rate adjustment to rent of $35,000. You'll see where that comes into play in a couple of slides from now. Generally, we can add back accounting and legal, typically because these are expenses that another third party probably wouldn't incur. And then we have to make sure that you're not missing any months of expenses. The common one that we see is rent. You may have 11 months of rent and none in December, and then January has 2 months of rent. So that's what we call normalization. We need to make sure that the rent, that you have 12 months of expenses. That's things like utilities and utilities and rent are the big ones, but make sure that there's expenses and some type of expense in each month. And then the other thing, sometimes you can't guess what a buyer will spend. So if you're spending a certain amount of dollars on benefits for your employees, or you do special things for your employees, those type of expenses, even though you may think that another provider wouldn't use them, what they look for is to understand your business. And if that's the type of thing that your employees are used to, then they'll want to continue that. So those type of expenses will need to be kept into the P&L. You can say, well, I spent a whole lot more on my advertising. Well, you can't really, guess what a potential buyer would spend on advertising. So those are the kind of things where we have to reflect how you run the business, because when another provider will want to run the business or have the same cost structure to provide the same type of service. For instance, another good example is organic lunches. They're expensive, but that's built into your cost structure and your revenue structure. So that would be something that a new provider would want to continue. And while you may be able to do it cheaper, that's just part of the way you operate your business. And that's what we have to value. And then lastly, we've got, I call it the fun stuff, is the seller adjustments. When we go through valuations and pick out, what the seller expenses are, it can be quite fun, and it can be a little bit challenging at times. I mean, the most clear, the clear examples are seller wages and payroll taxes, your healthcare costs and 401k, employer contributions. Typically, we see cell phone costs and your vehicle costs. Maybe the lease on your car is running through the P&L. So those are things that would go away or not as part of the operating costs of the company. And typically, we of course travel and entertainment for conferences and things, and maybe vacations. Like I said, we're not judging. We see a lot of that in travel and entertainment. And then there's personal expenses. We see a lot of times where, you've got, husband and wife and a couple of kids, and maybe they all have credit cards and they're running expenses through the P&L, which is fine. But, we want to make sure that we can capture those kind of expenses because they're not operating expenses. They're just part of the way you run your business for income tax purposes. But we have to pull those things out. And sometimes it can be very difficult. And if we can't support those expenses, either with credit card statements or invoices or something very concrete, it's difficult to get through a review process where those type of expenses would be allowed to be added back. Estimates generally, at an initial valuation, we do some estimates on that, but when we get to a full-blown process, we have to move away from estimates and go to direct invoices and credit cards. So if you have a lot of personal expenses run through the business, there's a number of different strategies, setting up a separate account for all that, a separate cost center or class in your QuickBooks, or a separate credit card that can be specifically identified and pulled out. Maybe you use Chase for all your regular operating expenses and American Express for your personal. We see that a lot, and that makes it easier and easy to justify as well. So now we put it all together, and we've got a revenue normalization. So we're removing 115,000. We've got our expense normalization. So we're adding some additional costs there, but we're adding, all the seller adjustments. So salary, payroll taxes, benefits, etc. So the net of all that is a negative $16,000, which gives us an adjusted EBITDA of $543,000. So that's the cash flow of the business for the most trailing 12 months, be it December or any other month throughout the year. And we like to look at adjusted revenue, percent of revenue. So this comes out to 21.7%. So now that we've got our 543,000 adjusted EBITDA, that's where we come to play. Well, what's the valuation for the operating business? And the answer is that it depends. And that's a frustrating answer for many people, but there's a lot of factors that have to go into determining what the multiple is. The higher the adjusted EBITDA, the more likely the multiple is higher. It depends on the location and the market. Or is it a rural suburban area, or is it in an urban area? Is it a high demand market where a lot of investors are looking to grow? That generally drives up the multiple. The amount of subsidy you have from your agency billings. Many companies specialize in agency tuition, subsidy tuition, but many don't, and so they may not even have a value to place on your business if they stay away from subsidy. And that just depends. It's just a matter of how much. A little bit is not as big of an impact as like over 50%. And that goes along with the buyer demand. That goes back to market, where you're located. And like Kathy said earlier, this is the quality of the program. Everybody's looking for quality. So, you might have to spend a little extra money to maintain that quality, but at the end of the day, that may very well get you a higher multiple. So in this example, we're using a range of 5.5 to 6 on this $543,000 adjusted EBITDA. And we use a range because ultimately it's going to be decided by the market what that value of your operating business will be. And generally, when you get a valuation from us, it's based on all these factors and our experience in the business, to try and give you the best representation of what we think your value would be. So now we'll look at the real estate. So this is in our single site example. We have a seller who owns a business and the real estate and wants to exit both. So when we look at real estate, as Kathy mentioned earlier, its ability to pay rent determines the value of the real estate to an investor. So I know a lot of people have had, third-party appraisals on their property that can come out quite high if you're looking at things like comparable sales or discounted cash flow or just revenue or just cash flow. All those can give whole different types of answers, but from an investor standpoint in a preschool business, they want to make sure that the rent that the operating company can pay the rent at a reasonable rate. And it's just rent is just another substitute for debt in a way. So when we look at market rents, we kind of look at a couple of different things. What is your normalized rent? So in our example, we added $35,000 to rent. In our estimation that the rent on this particular business could go up $35,000. So we look at it as a percent of revenue between, in the mid-teens, generally 15, 14, 15, 16% is kind of where we like to land at. Also, we kind of look at a price per square foot because we do have to look at some of the local markets and what their comparable square foots are to see and make sure that we're not wildly out of whack. And then there's a cash flow coverage, which is basically your adjusted EBITDA plus your rent divided by your rent. So it's basically how much cash flow, how many times does the cash flow cover your rent? And the general rule is it needs to be above 2, preferably, well above 2. And then once to figure out the value of the business, we divide the rent, the annualized rent, by the capitalization rate, or the amount of return that an investor will need to have to make the investment in your real estate valuable to them, and that gives you a real estate value. So in the example that we have here, so we said the adjusted market rent was $335,000. We have 14% of revenue. We have a $27.90 square foot rent. We have a cash flow coverage of 2.62 times. So the EBITDAR, or EBITDA plus rent, is 878, and that is 2.6 times the rent, which is a very healthy coverage. And then we used, in this example, I used 8 and 7.5%, and the cap rate fluctuates based on the interest rate markets. So currently, right now, those are tending to go down a bit. So maybe if I were doing this again, I probably would be a little bit lower on the cap rates. So when we look at the cap rate, the lower the cap rate, the higher the value of the business, mainly because the risk is lower with the lower cap rate. So we get a range of $4.2 million to $4.5 million on the real estate. And then we kind of put it all together. So we look at the business values somewhere between $2.7 million and $3.3 million, and the real estate between $4.2 million and $4.5 million, or a total overall valuation of $6.9 million to $7.7 million. And like I said, there's lots of things that go into the thought process of coming up with the numbers, but that's kind of the simplified version. When you get into, like I mentioned earlier, if you get into multi-sites, 4, 5, 6, 7 sites, and a corporate overhead structure, and how that's handled is, like I said, would be a whole nother probably presentation. There's a lot more intricate things that have to be considered, and a lot different type of investor pool that would probably be in consideration for those type of transactions. So Kathy, with that, I think that is done for my presentation. I hope everybody, that was clear. And if some of you were at Shift earlier last November, you probably heard a lot of the same things. So I hope I was consistent anyway.
Rusty's so good. I hope you, I love how Rusty's able to break down a very complicated concept, like you guys can see, into manageable theories. I see we have a very good question, which we'll answer. I'm going to make a couple of comments. And as I'm doing that, we'll take that question and you guys also pop whatever else you have in there. We have about 20 minutes. And so we'd really love to be sure that you leave here with your questions answered. So one thing I wanted to comment on is, even though we're predicting a range of business value, our go-to-market methodology is to not name a business asking price. So we put the information out in the world. The market competitive process determines the price. And we started that practice. It's probably been 15 years now when values started to creep up. It used to be, kind of crazy, but easy in the industry, because when I first started doing this almost my 40th year in the industry. Rusty, I know you're close to, but you're probably not quite as mature.
One less year.
Okay, well, I'm more fully depreciated, which I love. That was great. But we were a 3 to 5 multiple industry, which was kind of crazy based on what we see now. So the range for our transactions now are kind of 5 to, we've hit some 11s and 12s. So that's in the size group that we manage. But we don't name those values. We want a competitive process to name the value and for us to really know that we're getting a fair value for you. And it's one of the reasons we don't like the idea that a seller might just accept an offer without running a competitive process, and also having the support from professionals like Rusty to help you navigate that process. So we chugged up for about 12 or 13 of those 15 years. If we had named prices, we would have regularly left money on the table. And then about 2 years ago, we saw a little leveling of those prices. And I don't hate that, because it stayed at the height and it kind of normalized, and it's a little easier to predict when we're coaching our sellers about what to expect. Also, like Rusty mentioned on real estate values, we did from 2020 till about a year ago, we did see real estate values slightly compromised, and that cap rates probably changed a point, but they've now normalized too. So we're back to pre-COVID values on real estate. So that's good news. Let's hop over to some questions. The first one, which is a really good one by Jay, is that Jay has 3 locations. He owns 2, and he has a loan on one of them. And what would the value calculation look like? So we got a business that owns 3 businesses. We own 2 of the properties, and I'm assuming you leased the 3rd. So not unusual for us. We value, 20 site groups, and they might own 5, and they lease, 15, and maybe they have mortgages and maybe they don't, or maybe they choose to keep their real estate, which is fine. One thing you guys need to think about is that your business and your real estate are 2 completely separate assets. So Rusty, I'll let you address what that valuation might look like and which of the steps you described apply in Jay's case and how that would look.
So in that situation, whenever we have, anywhere from, well, I've done individual valuations on up to 20 locations. So whenever we have multiple locations, we always do a separate valuation for each location. We generally don't do it in the aggregate. So we'll evaluate each school and figure out what the investors call a 4-wall EBITDA, which gives us the operating cash flow for each of the 3 locations. And for the lease location, we'll make sure that there's proper expenses on the lease. We understand where property taxes are. And then on the 2 owned locations, we'll go through a similar exercise that we just talked about. And there might be different rents for the 2 separate locations depending on their cash flow or the size of their business or the size of the facility. So that's also a variable. And then we would generally just add the 3 locations up and get a total operating a business valuation and then a total real estate valuation. So that also gives you an option to be able to think, well, maybe I want to keep the two that I own and lease it back to a new provider and give you a cash flow of 15, 20 years if it's makes sense to you and what your goals are. So that's why even if you we're deciding to keep the real estate, we always do it as if you're contemplating selling it or leasing it, just so you have the option to figure out what your, what makes most sense in your, personal financial situation.
Yeah, I like that, Rusty. So we're giving you guys, with your own real estate, we're going to give you options. We're going to show you both what a market rent for your real estate would be and what you would get for it if you sold it. So that helps you make a decision about, what do I do with the real estate asset. I'll add that the majority of our business selling clients also want to exit their real estate. They typically don't want to maintain that. They want to go ahead and exit everything. But some people choose differently. So, Rusty, another great question. How do we determine the appropriate square foot rent rate? So I think rent per square foot, how are you determining that?
Well, that's generally market-based. Like Northern Virginia would be a higher market rate per square foot than, say, Nashville, Tennessee. That's kind of doing, we have some software that we use to evaluate, as close as we can to comparable properties, what the square foot in the area is. It's just one of the three factors that we look at. We just want to make sure that it's not too outrageously higher than the average or too low for the average. But as I said, you have to balance it between the percent of revenue and the coverage, the rent coverage ratio. So, it's all market-based driven, and there's several different software that help us provide that information.
Yeah, great. I'll take the first stab at whether Hinge helps with valuations for a multi-franchise unit, and what about finding a buyer. So interesting, assuming you're saying you're a franchisee and you own multiple schools. So if we're just talking about non-franchise multiple schools, then absolutely, and it's really where our specialty area is. If we're talking about multi-site franchisees, that is becoming a really interesting market shift. So where Hinge can get involved in smaller franchisee ownership sales is when that franchisee is leaving the franchise system. And here's the reason. We don't sell to individuals, which typically require some public marketing. We do not publicly market anything. We have a very tightly controlled process where buyers or investors have to sign confidentiality before they even know who is being marketed, what company is being marketed. So we only go directly to our buyer database, which is about 650 entities, both private equity community and strategic groups, which means groups that already operate schools. For multi-site franchisees, there's a very interesting new strategy going on, new-ish, but it's happening in a bigger way, where private equity companies are investing in multi-site franchisee level organizations. So maybe, as the answer to your question, it depends on what it looks like. So where we help with franchisees is, first of all, if they're exiting the system, and second of all, if they're in the realm where they might be a target for a private equity investor. I'm happy to talk to you more about that. Okay, so Rusty, is there a magic number in EBITDA or location count where you start to see double-digit multiples? You want me to take that?
Yes.
Rusty just asked a lot of questions about multiples, but that's kind of more my job than Rusty's job. So to understand the market and the strategies around the potential investor is more on the advisor side, where Rusty's Rusty's job is threefold with Hinge, along with his two team members, Marnie and Paolo. They perform our initial valuations that we use to coach our potential clients on what their business and real estate could gain. We do that before we list a company, because how are you going to make a decision about whether to list your company if you don't know what the market might bring for your company? So that's their first job. Once we list a company, Rusty and his team do their second process, which is a financial review, much like a precursor to the audit or QOE, quality of earnings, that the buyer will commission to verify your numbers. And the reason we do that is you don't want to go to market if some very key financial things are not verified. So that's a unique service that we provide. And then the third one is they defend their work in the quality of earnings process on your behalf if you get under contract. So that's the work they do. So the magic number in EBITDA or location count where you start to see double-digit multiples. So if you're talking about a 10 multiple, you're in the 5 million to 10 million range in EBITDA. So if we are talking about companies with one, and this is after Rusty's massage and adjustments, so it's not what your financial statement looks like. So unless you know all the nuanced steps to take, then it might be tricky to know what your go forward EBITDA is. So if you're between 1 and 2 million in EBITDA, our range is going to be in the 6.5 to 7.5 multiple range. If you're in and here are the breaking points, 2 million to 5 million, we're now going to be in the 7.5 to, let's call it upper 8s. And if you're in the 5 to 10 million, which I assume is, one of those buckets is everyone here. If you're not, reach out separately and we can certainly talk about that. But 5 to 10 million will be more in that 9 to 11 range. So that's kind of where the market is right now. Does the valuation seminar provide information useful to franchisees more focused on non? Again, it depends on where you're selling. We only sell outside of systems or larger franchisee organizations. I will say that what I hear is that when franchisees trade within their system, I regularly hear a 5 multiple. So that's different from ours. It's a bit lower. But that's what I hear. We don't do that work, so I can't really claim that for gospel, but that's what I hear. Rusty transferred the property taxes from the real estate LLC to the operating business, but if the operating business is paying rent, which includes property taxes as part of the rent, so I'm assuming to a third party, you're paying rent, and it does actually include the property taxes, what do you do then, Rusty?
Well, then if it's a true third-party rent and it's a part of the a base rent plus property taxes and utilities or insurance, then we wouldn't add back the property taxes because that's already incorporated in your rent. A lot of rents are set up as, even with a third party, is what's called a triple net rent, where the operator pays property taxes, insurance, all the operating expenses of the real estate in addition to their rent. So we just want to, if you have a third party rent, we have to make sure you have all those items that are in accordance with the lease. The example that we used was, you own the real estate, and for whatever tax purposes, however you structured your business, and you wanted more expenses on the real estate side to offset some of the rent, et cetera. That's kind of the why you would do that. And when we value the business and the real estate, we're valuing the lease as a triple net lease, because that's for the most part what any buyer would be looking at offering or wanting as a part of the transaction, so that they want to make sure that the rent is the rent, and then separately you pay the property taxes and insurance for the property, et cetera, whatever's included in the lease. So that's kind of why you saw that example like that. So like I said, if it was a true third party lease and the landlord is paying the rent, then there is no adjustment.
That was a great question. So thank you for asking it. And it just highlights one of so many variables that could happen. And that's what Rusty means when he says it's nuanced. And a lot of times we call it more of an art than a science, because it really takes a lot of experience. Between Rusty, me, Marnie, and Paolo, we have more than 100 years experience in valuations in this industry. Not in, we've got more than that in other industries, but in this industry. And that's kind of what it takes to really understand all those uniquenesses. So Kim is coming to South Carolina in April. Yay, we're so excited. It's an amazing town. We're happy to have you here, Kim. Yes, so to begin determining your school valuation of real estate, you should have gotten information to submit your financial information to us, and then to arrange a one-on-one time, Kim. So I'm sorry if you did not get that. I will reach out to the team and be sure that they get you what you need. And we're super excited to see you. Do HINGE Advisors represent both buyer and the seller, since you have partnerships on both sides? They are not partnerships, but thank you for asking that question. On the buy side, they're not partnerships. We do not represent buyers. And I'll tell you why. In my first life, I was a buyer, and so was Rusty. So I grew a company from 5 to 120 schools. Rusty worked for one of the nation's largest groups who acquired schools regularly. So we were both evaluating opportunities only for our company. Here's what bugged me about that. I saw underrepresented, under-resourced sellers who I thought could do better in a competitive process. And it drove me so crazy that I quit my job and started HINGE 23 years ago, because I wanted to support the sellers who I feel like deserve options. They deserve pure representation. They deserve to be shown to multiple companies. Now, do we know them, and do we know how they run a process and what we like and we don't like? Sometimes, sometimes you're an opportunity for someone we've sold to before, or maybe more than once before, and that's great information. I have actually taken buyers off of our list if I don't like the way that they run a process. And it's not just about having the money to close. For me, it's equally about how they care for your people in the transition and afterwards. So if I don't feel like they act fairly, they come off the list, and it's only happened once. And a few years later, they came back to me and said, well, what do we got to do? What do we have to do to be able to see things again? And I said, here it is. And they did that, and they have proven to be an amazing buyer. So we do not represent the buyers, but we have relationships with buyers, but don't represent them. We exclusively represent people like you. So thank you for that. Any more questions? We got like 4 minutes. Does anybody want to pop one in? I will add, just while I'm waiting to see if we have one more. Rusty, one of the things you mentioned were the things that move valuations toward the top of the range, and you mentioned a few. Two things I want to just mention that are good examples of quality, because sometimes it's hard to talk about your program quality in a way that people can grab onto and believe in. Accreditations are a good concrete way to show your curriculum and your operations as strong. Another one is to continually reinvest in your building and your branding of your building. And there are people that specialize in that, but to keep your building looking amazing. And it sounds crazy because, you know, if it's a beautiful building and things are happening in the classroom, that's not good. But I'm assuming you're already doing that. But sometimes people can't really see it in a 15-minute tour. This is true of parents and people enrolling as well. So those are two little tips. You're interested in selling your franchise school. You've reached out. I have not heard back. Oh my gosh, I am so sorry about that. I am on it. We would be very happy to tell you whether we can support you or not. So apologies for that. We will certainly get right on that. Rusty Bailey, thank you very much for that content. I hope you guys realize how valuable that was. And it wouldn't surprise me if, as Rusty was going through some of the concepts, you're like, you know, can't wrap my head around it. We will talk you through these concepts over and over and over as many times as you want. We do not expect people to be financial wizards. It's great job security for us. If you're not, it's what we do all day long, all year long. So we are happy to support you with your needs in either exiting or gaining an investor. Thank you for joining. We're honored that you would spend your hour with us when those hours are so valuable. So thank you, Rusty Bailey. Thank you, friends, for being here. And we will see you next month when I'm joined by Alec Ligon to talk about the mechanics and the process of selling your business. So hope to see you guys there. Take care and be well.